Hello everyone, welcome back to Hash Commerce and Dollar Accounting. In today's session we are going to discuss a crucial topic in accounting, depreciation accounting. If you own a business or work in accounting, you must have noticed that assets like machinery, buildings and vehicles lose value over time. This decrease in value is known as depreciation. But why does this happen? And how do we record it in accounting books? Let's find out. Depreciation is the systematic allocation of the cost of a fixed asset over its useful life. It represents the wear and tear, obsolescence, or passage of time that causes an asset's value to decline. Depreciation is a non-cash expense, meaning no actual cash outflow occurs. However, it reduces the book value of assets and affects the net profit. Example. Imagine you buy a machine for $10,000 and its estimated life is 10 years. Each year the machine loses value and this loss is recorded as depreciation. Now let's talk about the causes of depreciation. Wear and tear. Due to continuous usage, assets lose efficiency. Obsolescence, new technology can make older assets less useful. Time factor. Some assets lose value over time even if not in use, like leasehold property. Natural factors. Weather conditions can damage assets. For example, a company might replace old computers every 5 years due to obsolescence. Or consider a construction company that depreciates its equipment faster due to heavy use. Understanding these causes helps in accurate financial planning and reporting. There are several ways to calculate depreciation. The two most common methods are: a fixed amount of depreciation is charged every year. The formula is depreciation equals the cost of the asset minus the scrap value divided by the useful life. For example, if a machine costs $10,000 with a scrap value of $1,000 and a useful life of 10 years, the annual depreciation will be $10,000 minus $1,000 divided by 10, which equals $900 per year. Now consider office furniture costing $5,000 with a scrap value of $500 and a useful life of 5 years. The annual depreciation will be $5,000 minus $500 divided by 5, which equals $900 per year. The written down value WDV method involves charging a fixed percentage of depreciation on the book value each year. The formula is simple. Depreciation equals book value multiplied by depreciation rate in percentage. For example, if a machine costs $10,000 and the depreciation rate is 10%, then for the first year the depreciation would be $10,000 multiplied by 10%, which equals $1,000. Consequently, the book value for the second year would be $9,000 and the depreciation for that year would be $900. Different asset types may have varying depreciation rates. For instance, a vehicle might depreciate at 20% while office equipment might depreciate at 15%. Using the WDV method, the depreciation amount decreases each year, reflecting the asset's reducing book value. Let's discuss how to record depreciation expense. The entry is as follows. Depreciation account debited 900 rupees. To asset account credited 900 rupees, being depreciation charged on asset. Next, let's look at transferring depreciation to the profit and loss account. The entry is profit and loss account debited 900 rupees. To depreciation account credited 900 rupees, being depreciation transferred to profit and loss account. Here are some examples for different types of assets and varying depreciation amounts. Machinery, depreciation account debited 5,000 rupees. To asset account credited 5,000 rupees. Vehicle, depreciation account debited 2,000 rupees. To asset account credited 2,000 rupees. Building, depreciation account debited 10,000 rupees. To asset account credited 10,000 rupees. Depreciation impacts financial statements in significant ways. First, in the profit and loss account, depreciation is recorded as an expense, which reduces the net profit. Second, on the balance sheet, the asset's value is reduced over time, which affects the total asset value. Different depreciation methods, such as straight line and declining balance, can have varying impacts on profitability and asset valuation. For instance, using the straight line method results in consistent expense amounts. while the declining balance method leads to higher expenses initially, affecting net profit differently. Ultimately, the choice of depreciation method can significantly influence financial strategy, asset valuation, and overall financial health. To wrap things up, depreciation helps in the fair presentation of financial statements. It ensures that businesses allocate asset costs systematically over time. Understanding different methods helps accountants choose the best approach based on business needs. That's all for today. I hope you found this session useful. If you did, don't forget to like, share, and subscribe to Hash Commerce and Dollar Accounting for more insightful videos. Here's a question for you. Which depreciation method do you think is more useful for businesses, SLM or WDV? Comment below. See you in the next video. Before we go, let's touch on an important aspect: depreciation in tax accounting. Depreciation is not only important for financial accounting, but also for tax purposes. Tax laws often have specific rules for calculating depreciation, which can differ from financial accounting methods. Understanding these differences is crucial for accurate tax reporting. For example, while financial accounting might use the straight-line method, tax regulations might require a different method, like the Modified Accelerated Cost Recovery System, MACRS, in the United States. These differences can affect a company's tax liabilities and financial planning strategies. So it's essential to consult with a tax professional to ensure compliance and optimize your tax benefits. Thanks for watching. And don't forget to like, share, and subscribe to Hash Commerce and Dollar Accounting for more insightful videos. See you in the next one. Depreciation in different industries. Different industries have unique depreciation practices. For example, the technology industry may have faster depreciation rates due to rapid obsolescence, while the real estate industry may have longer depreciation periods. Let's explore how depreciation varies across different sectors. In the technology industry, assets such as computers and software can become obsolete within just a few years. This rapid pace of innovation necessitates a faster depreciation rate to accurately reflect the decreasing value of these assets. On the other hand, the real estate industry often deals with assets like buildings and land improvements, which have much longer useful lives. As a result, these assets are depreciated over extended periods, sometimes spanning decades. The manufacturing industry also has its own depreciation nuances. Machinery and equipment used in production lines may undergo significant wear and tear, leading to higher depreciation rates compared to office furniture or fixtures. Similarly, the transportation sector must account for the depreciation of vehicles, which can vary based on usage and mileage. Understanding these industry-specific practices is crucial for accurate financial reporting and strategic planning, whether you're in tech, real estate, manufacturing, or transportation. Knowing how depreciation affects your assets can provide valuable insights into your business's financial health. Thank you for watching, and don't forget to like, share, and subscribe to Hash Commerce and Dollar Accounting for more insightful videos. See you in the next one. Now that we've explored depreciation in different industries, let's dive into some advanced depreciation methods beyond the straight line and written down value methods. These advanced techniques include the sum of the year's digits method and the units of production method. The sum of the year's digits method accelerates depreciation by assigning higher depreciation expense in the early years of an asset's life and lower expenses as the asset ages. This method can be particularly useful for assets that lose value more quickly in their initial years. The units of production method, on the other hand, ties depreciation to the actual usage of the asset. This method calculates depreciation based on the number of units produced or hours used, making it ideal for machinery and equipment that have variable usage rates. By using these advanced depreciation methods, businesses can achieve more accurate and representative depreciation calculations for certain types of assets, leading to better financial planning and reporting. Thank you for watching, and don't forget to like, share, and subscribe to Hash Commerce and Dollar Accounting for more insightful videos. See you in the next one.